In late December 2017, a high-flying executive quietly slipped into a confidential meeting at a powerhouse San Francisco law firm. He was the chief operating officer of Twitter, but he wasn't there to talk about social media. He was there to pitch himself as the savior of a toxic, hyper-growth financial startup whose billionaire founder had just resigned in utter disgrace after an illicit relationship with an employee. This executive, a disciplined West Point graduate and former Goldman Sachs banker, walked into the boardroom and fired up a hyper-detailed PowerPoint layout. He mapped out exactly what he would do in his first 45, 60, 90, and 180 days. His master plan turned this niche startup into an absolute financial supermarket that would lock in customers from high school graduation all the way to the grave. His ultimate goal was to scale the company's value past $20 billion. But the executive brought serious baggage. Earlier that year, shareholders slammed him with a massive lawsuit accusing him and Twitter's CEO of hiding a massive decline in daily active users. Well, that case eventually settled for a staggering $810 million with no admission of wrongdoing. The startup's board didn't care. They were mesmerized by his precision. The board hired him on the spot. That executive was Anthony Noto, and the company he took over, SoFi. For the next 8 years, Noto executed a classic relentless banking playbook. He cleaned up what insiders called a toxic Silicon Valley bro culture, established strict corporate values like do the right thing, and forced every single division head to take absolute responsibility for their own profits and losses. He rapidly expanded SoFi from just 3 core loan products to 12, flooding the market with credit cards, checking accounts, budgeting trips, crypto investing, mortgages, and small business loans. He even dropped over $25 million a year in a massive 20-year branding deal to slap the company name onto the Los Angeles Rams home field, SoFi Stadium.
The SoFi Stadium. Home to the LA Rams and LA Chargers, this revolutionary build cost over $5 billion, making it the most expensive sports ground in the world.
And for a long time, the hustle completely paid off. SoFi rocketed up the charts to become the 50th largest bank in the entire United States, holding roughly $50 billion in assets. Noto himself was rewarded like a king, pulling in $103 million the year he took the company public via a SPAC in 2021 and another $30 million in 2025, minting him a personal net worth of roughly $400 million. But right as the celebration reached its peak, Wall Street took a closer look under the hood. And what they found triggered a catastrophic 50% stock market crash in a matter of months. In March 2026, a notorious financial short seller called Muddy Waters dropped a brutal 28-page, 12,000-word atomic bomb of a report on the company. They explicitly accused SoFi of using Enron-esque accounting tricks, calling the entire business a financial engineering treadmill designed to make management fat while leaving shareholders as the ultimate losers. Mainstream stock analysts rapidly turned on the company, downgrading it to a mediocre hold rating, leaving it trapped in the doghouse behind fintech peers like Robinhood and Affirm. As one prominent KBW analyst bluntly put it, investors are starting to realize SoFi is really just a traditional lending business.
Well, and I keep going back to what the expectation was, at least we were talking about this yesterday, with some of these fintech plays. I mean, the thing that BTIG pointed to was their path to profitability, that it was more likely than some of their other competitors. And yet when you think about where it has been priced, what's more than doubled this year, if you look at where the stock is?
To understand how they got stuck on this treadmill, we have to look back at how this monster was born. Back in 2011, inside a famous Stanford business school class called Startup Garage, a gifted communicator named Mike Cagney co-founded what was then called social finance. Federal student loans always charge the exact same interest rate, regardless of whether you were a high-risk dropout or a genius coding prodigy at an elite university. Cagney realized a massive loophole. He could offer low-interest financing specifically to alumni of top 50 elite schools like Harvard, MIT, and Stanford because their risk of defaulting was incredibly low. Cagney was a fundraising machine, vacuuming up a stunning $1.4 billion in equity capital in just 4 years. To fund the actual loans, he brought in a secret weapon, CFO Nino Fanlo, a former Wells Fargo and KKR private credit executive who used his deep Wall Street Rolodex to get institutional funds to buy up SoFi's loans. But it all imploded in 2017. A string of workplace scandals involving Cagney's extramarital relationship with an employee and allegations of highly inappropriate behavior by Fanlo forced both executives out, leaving the company desperate for an institutional heavyweight like Anthony Noto to steady the ship. Noto survived the pandemic's massive threat when the government paused student loan repayments by aggressively pivoting into high-margin personal loans and securing an official bank charter in 2022 to rake in customer deposits. But this massive personal loan pivot is exactly where the accounting magic tricks begin. As JP Morgan CEO Jamie Dimon famously quipped last year, you can drive a truck through accounting rules.
I don't upfront profits when I can spread them over time. And accounting, of course, accountants hate it when I say this, you can drive a truck through accounting rules. And accounting itself, that certain things are considered expenses, but they're good.
There is an immense amount of flexibility in how a public company states its profits, and critics argue SoFi has been driving a massive semi-truck right through those gray areas. It all comes down to something called fair value accounting. When SoFi originates billions of dollars in unsecured personal loans, mostly to people consolidating credit card debt, they don't wait for those borrowers to pay them back over years to record a profit. Instead, GAAP accounting rules allow them to estimate what those loans are worth right now if they were to sell them to outside investors on the open market. The absolute key variable in this math equation is the discount rate. The lower the discount rate a company chooses to apply, the higher the estimated value of the loan book becomes, allowing them to record massive immediate upfront income on their balance sheet. Look at how SoFi stacks up against its direct competitor, LendingClub. SoFi applies an incredibly low discount rate of 4.6% to its personal loans, a rock bottom rate sitting within a single percentage point of risk-free US government treasuries. LendingClub applies a far more conservative discount rate of 7.2%. Now, SoFi's borrowers do have slightly higher average credit scores, a 745 FICO score compared to LendingClub's 720. But multiple institutional debt experts have come forward stating that it is completely unrealistic to think any real-world investor would buy consumer loans at a rock-bottom 4.6% return when they can get nearly the same yield from risk-free government bonds. Investors typically demand a 1.5 to 2% premium above government bonds to take on the risk of regular people defaulting. Now let's look at the actual damage. By the end of 2025, SoFi was holding a staggering $20.2 billion in unsecured personal loans. If you recalculate the value of that massive loan book using a more conservative, realistic 5.5% discount rate instead of their preferred 4.6% discount rate, it would have completely wiped out roughly $275 million in cumulative pre-tax profits over the life of the business. To put that in perspective, SoFi reported $526 million in pre-tax profits for 2025. Stripping away their accounting buffer slashes their historical profitability into half. SoFi spokespeople completely deny these claims, calling them patently false and pointing out that their numbers are fully vetted by internal boards, third-party auditors, and federal regulators. They also argue that since 2024, their actual cash interest income has been double their non-cash paper valuation gains. But when SoFi pointed to an investor presentation claiming they successfully sold a bundle of loans at a premium, Wall Street looked at the sample size. The sale they boasted about was a tiny $175 million in Q3 of 2025 and an even smaller $100 million in Q4. That represents less than 1% of their total personal loan book. Even worse, in the first quarter of 2026, their whole loan sales dropped to a flat zero. When analysts tried to press management on the exact age or day one value of these sold loans to verify the math, the company completely clamps down. In fact, over the last 4 consecutive quarters, SoFi's management has refused to take a single earnings call question from any Wall Street analyst carrying a sell or underweight rating on their stock. One equity research analyst at Compass Point revealed that SoFi had continuously dodged his questions and postponed scheduled phone calls with him for over 2 full years. But the accounting rabbit hole goes even deeper than loan valuations. It spreads directly into how they handle their massive marketing bills. When a normal tech company or retail bank runs an ad campaign to get you to sign up for an account, they treat that ad spend as an immediate expense. If they spend $10 million on ads this month, their profit for this month drops by $10 million. Simple, right? Not SoFi. Instead of expensing their marketing costs immediately, SoFi utilizes a highly unusual tactic. They capitalize their marketing costs, amortizing and spreading the expense out over 5+ years. The short-term boost this gives to their public face is mind-boggling. In 2024 alone, SoFi capitalized $177 million in marketing expenses. If they had recorded those marketing costs the way normal businesses do, their 2024 net income before taxes would have been a massive 76% lower. Even crazier, they're actually capitalizing more marketing debt than the underlying products are even generating in revenue. Leading up to the end of 2025, SoFi accumulated $408 million in capitalized marketing expenses for its brokerage and debit card segments. Yet those exact business segments only generated $382 million in total revenue over that same multi-year time frame. When investigative journalists asked SoFi to provide basic examples of these marketing materials to see how they legally qualified for this rare accounting treatment, a spokesperson flatly declined to share them. This compounding web of aggressive accounting tricks combined with a highly inflated valuation multiple trading at nearly 70 times its earnings while traditional powerhouses like JP Morgan trade at 15 times or less is exactly why big money managers are fleeing the stock. Elite institutional investors hold just 54% of SoFi shares, a number that sits miles below its major fintech rivals and 3/4 of the top 100 largest banks in America. Stripped of its flashy Silicon Valley tech narrative, the harsh reality of 2026 has set in. SoFi is fundamentally just a traditional consumer bank without physical branches. In the first quarter of 2026, a massive 88% of SoFi's $1.1 billion in net revenue came strictly from its lending services. Anthony Noto has desperately tried to fix this by spending billions to acquire back-end tech infrastructure platforms like Galileo for $1.2 billion and Technisys for $915 million billion, hoping to sell tech infrastructure to other institutions. But that non-lending tech engine is actively stalling out. Their tech segment revenue just plummeted by $28 million in the first quarter of 2026 after losing neobank titan Chime as a core customer. When you strip away the Chime disaster, the segment grew at a sluggish 12%. The moment those earnings went public, the stock plummeted another 15% in a single day. The stock's brutal freefall has officially crippled Noto's grandest ambitions. Insiders have revealed that late last year, Noto made a quiet, unsolicited blockbuster proposal to buy Column, a powerful tech infrastructure firm run by Plaid co-founder William Hockey, for a staggering $6 billion. Noto's plan was to fund this massive transformational acquisition using SoFi's highly inflated stock. But as the calendar turned to 2026 and the market finally woke up to the financial engineering powering the company's books, the stock collapsed. With their primary currency completely eviscerated, the secret merger talks completely broke down and died. Anthony Noto successfully built an incredible multi-product banking powerhouse from the ashes of a toxic startup scandal. But as Wall Street shifts its gaze away from flashy stadium titles and focuses on the reality of the balance sheet, the tech illusion is officially fading, leaving a standalone consumer bank holding a multi-billion-dollar mountain of paperwork. I'm Balaji, and this is how I see it. I'll see you next time.